and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. Let's have a look at the stories for the day. Soon, Android phones will not come preloaded with Google apps like YouTube, Chrome, and Gmail. After the Competition Commission of India's order, Google is now working with original equipment manufacturers to unbundle the distribution of Play Store. So, is it good news for Indian app developers? Tushar Verma answers.
The Supreme Court of India, in its recent ruling, upheld the decision of the Competition Commission of India, or CCI, on Google India. Along with levying a fine of 1,337 crore rupees, the CCI has asked Google to unbundle its apps. This essentially means that Android devices, other than the ones manufactured by Google itself, will not have pre-installed Google apps such as Chrome, Photos, Google Search, and Google Maps. This is expected to give a boost to third-party app developers. Google, reacting to the Apex Court's ruling, said that this will hurt consumers and stall growth of Android platform. As of 2021, India had more than 29,000 app developers that published 150,000 apps on the Google Play Store. On a global scale, all Indian apps account for less than 3% of all the apps available for download on the Play Store. Nevertheless, the in-app revenue generation from Indian apps is significant. In 2021, revenue from Indian apps was $60 million. The CCI pursued Google India based on the premise that it was exploiting its dominant position in the market. Not to mention, the tech giant accounted for a whopping 84,000 of all searches. Bing, with the second largest share of search, had a mere 8.5% share, followed by Yahoo at 2.55%. Allowing third-party apps to be installed easily on Android devices and even hosting third-party app stores on Play Store will enable Indian app developers to tap into the market.
The rules of anti-competitive laws say that when a company is dominant, it must not pursue practices which stifle competition. So the bar is higher for companies which are dominant. Google has achieved dominance. It's very clear. So they have to act in a much more egalitarian manner. Now, this is what the cycle of competition and life is, where startups can come up in an innovative open environment, become bigger, and if somebody becomes dominant, then they must also allow for others to come up.
Google apps enjoy a very large user base. Take YouTube for example. There are 225 million YouTube users in India. This is the highest in the entire world. When it comes to internet browsers, Chrome is the leader in market with a market share of 86%. The same follows for Gmail, Google's email service. While Microsoft's Outlook has been gaining ground, Gmail is the dominant service with an estimated 356 million users. All these apps and more come pre-installed with all Android devices. While the SC decision will ensure Android devices will not have them pre-installed, users may still drift towards Google apps because of the sheer presence. So, how can Indian app developers tap into this market?
You remember the time when apps like Google Maps first came to the market, they were pretty bad. The initial iterations for the first few years, people used to laugh at Google Maps app that it was so buggy. But over time, people became comfortable using it, and Google Maps also improved. Comparatively, at least I can say MapIndia's Mapples app is much, much better. And so, yes, of course, consumers should end up using whichever they like more. I believe that the natural drift may be over time, if people give it a chance, towards alternatives such as MapIndia Mapples.
CCI is not the first anti-competition agency to go after Google. The European Commission had also fined the tech major and asked it to unbundle apps. However, its order only asked unbundling of Google Search and Google Chrome. CCI's order, on the other hand, is more sweeping, affecting 9 Google apps. Will Google face similar anti-competition suits in other countries?
I do think that the Indian ruling is trend-setting in a lot of ways. They have taken to the logical conclusion where Europe had started out. Europe was looking at 2 apps, and so they ordered the unbundling of 2 apps. India looked at all of them and said that you must unbundle all. The principle is exactly the same. What this means is that there will be greater choice for OEMs as to what apps they put on their phone, greater choice for users as to what apps they download and what apps they choose to uninstall from their phones. So I think that's really the big change. And absolutely, I see other jurisdictions following suit and looking at this order and taking heed from this order.
Google India has seen a steady rise in its advertising revenue as well. In FY22, gross sales of advertisement space grew by 79% year on year to touch almost 25,000 crore rupees. It registered net revenue from advertising space sales of 2,000 crore rupees. With its app not being mandatorily installed anymore, will Google see a hit on its revenue?
So I see this more as an opportunity for the market. And as a competition lawyer, I've always believed that competition is good for the market. We have to move into the digital space, and Google as a gatekeeper can no longer keep out the indigenous Indian app developers. In order to keep its ad revenues up, it will now have to compete. It will now have to innovate. It can't just sit as the monopolist, keeping everybody else out and therefore making monopoly profits. It can certainly make profits. It just has to provide a better customer service and a better product for that purpose.
The Supreme Court directive came as a good news for Indian app developers who will now have a level playing field with the tech giant. While Google will continue to dominate the space, the unbundling would mean the company will have to make its product more secure and user-friendly to sustain growth.
Several Indian startups have hailed the CCI ruling on Google, saying that it will give a level playing field to smaller players. But of late, startups are facing funding crunch and governance lapses are also surfacing. Several Indian startups funded by Sequoia Capital were found embroiled in cases of financial fraud recently. Even as the venture capital major plans to audit its investments across South Asia, do these increasing cases signal a larger governance deficit in the entire startup ecosystem, diverse as it is? Debarga Sanyal's report explains.
Go Mechanic is in the midst of restructuring now. It is laying off 70% of its workforce and is reportedly tapping Cars24 and Spinny for a distressed sale. Big lapses have emerged in its financial reporting. The major investors of the car service aggregator have said in a statement that they were recently informed of serious inaccuracies in the company's financial reporting. A statement issued jointly by major investors of Go Mechanic went on to say that we are distressed by the fact that the founders knowingly misstated facts, including but not limited to the inflation of revenue which the founders have acknowledged. All of this was kept from the investors. Go Mechanic's co-founder Amit Bhasin has also admitted to the irregularities. 60 of the total 1,000 or more service centers were found to have possibly violated accounting norms to overstate revenue and divert funds by auditing firm EY, according to a Bloomberg report. Go Mechanic is not the only startup backed by Sequoia to come under the spotlight for corporate governance issues and financial scandals. Prior to this, other portfolio startups such as BharatPe, Trell and Zilingo were also in the dock for allegations ranging from financial and accounting irregularities to lax implementation of norms. In April 2022, risk and financial advisory firm Kroll had found financial wrongdoings at Zillingo during a due diligence process for a new funding round. The Singapore-based fashion startup's board first suspended and later fired its CEO Ankiti Bose for financial irregularities. A month before that, an EY review alleging serious financial irregularities stalled lifestyle social commerce platform Trell's over $100 million funding round and ultimately led the company to lay off over 300 of its 700 employees. And in January last year, risk advisory firm Alvarez and Marsal flagged indications of financial fraud consisting of recruitment irregularities and non-existent vendor payments at fintech unicorn BharatPe. The firm subsequently fired 15 employees, including co-founder Ashneer Grover's wife Madhuri Jain. In December, BharatPe filed a civil lawsuit as well as a criminal complaint against Grover and his family in the Delhi High Court, seeking 88.67 crore rupees in damages. On Wednesday, the fintech firm announced the appointment of 3 top executives in compliance and corporate governance roles. The BharatPe imbroglio is similar to the one faced by Housing.com in 2015 and the unceremonious exit of its co-founder Rahul Yadav, who later described his behavior as immature. The company rose to prominence just before the first massive waves of foreign VC capital entered India's startup landscape. So now, the regional arm of Sequoia Capital in South and Southeast Asia is weighing special audits of several investments in the region. The venture capital firm will work with Ernst & Young on some of these audits and will increase budget allocations to help investee companies put governance guardrails in place. The cases at BharatPe and Housing.com in 2015 paint a picture of a startup culture obsessed with superstar entrepreneurs at the expense of developing sustainable governance structures. Another startup is also attracting a lot of attention due to similar reasons. EdTech major Byju's, which is India's most valuable startup with a valuation of $22 billion, missed the deadline to file its audited results by 17 months. Its auditor, Deloitte, had also refused to sign off on the company's financials, citing irregularities in their revenue filing. So are these cases then symptomatic of a more extensive rot in the entire startup ecosystem, diverse as it is?
It to be generalized to say that there's a governance issue across all startups, I think that would be a very wide brush to paint. I think the issues that have come out are not so much compliance issues, they are systemic financial control issues. Yes, compliances are lax, but it's not the intention of everybody to have financial irregularities or lack of financial controls. Most of the startups do actually run a very tight ship.
Parth Gandhi, founder and CIO at Bombay Capital Management, also believes this is not a sector-wide phenomenon.
I do not believe there is a widespread issue with governance across all startups in India. Of the dollars, the billions of dollars deployed into the Indian market, how many of these governance issues are actually there? That issues exist, but is it 10% of dollar deployed? Is it 10 basis points? I'd venture and guess it's closer to 10 basis points. Is it good? No. Should it be improved? Yes. But let's keep in mind as to the order of magnitude where this is happening, and it's pretty low.
However, while the issue might be resolved in a case-to-case basis, do these examples point towards wider industry practices which VCs must exercise as precautionary measures?
See, there is a significant difference between diligence and audit. Diligence is on the basis of documents prepared and given to you by the company. You are not questioning the creation of the documents themselves. When investors come in, they do a diligence on the basis of which they form a certain view, whether something is right, something is wrong, something could have been done better, etc. They are not actually conducting an audit. They are not looking at all the backup documents for every one of those entries which have been made. So, see, first of all, you invested in the company because you believed in the promoter. So, open dialogue, better participation at the board, and last but not the least, ensure proper financial control, however it might be.
Having consistent, constant contact with the portfolio company is important for all of us. Whether that be through MIS, whether that be through touching, be actively involved in the board, all of that is true. Again, am I saying it's not happening? That's not true. I think it is happening, but it can be improved. So at the beginning, more diligence, followed up by post-investment, consistent and constant contact, and through board sessions, having a strong ability to identify when issues are coming up and jump in and correct them early.
Industry experts are not worried that Sequoia's misfortune with its recent investments is a signal for the larger Indian startup sector to tighten its belt. They do, however, believe that certain preliminary measures need to be taken by the VCs while dealing with and keeping in account of the promoter companies.
With just 4 days left for the budget 2023, this last full budget before general elections 2024 is likely to focus on economic growth amid global headwinds. On a strategic level, analysts expect the continuation of broad reforms to boost manufacturing, infrastructure, metal and banking sectors. Here's a report.
Over the years, the government has increased its capital expenditure to give a much needed thrust to infra spending. Like in earlier budgets, analysts expect the government to primarily focus on job creation and achieving investment driven growth in this budget too. With a focus on increasing capex, India's public infrastructure such as roads, water, metro, railways, defense, digital infra, and green technologies is likely to get a boost. The expansion of production-linked incentive scheme beyond the existing sectors could bolster the manufacturing sector, say analysts.
If we take a cue from the Union Budget 2018-2019, we have seen that despite the elections ahead, the Government of India will continue to focus on growth. That is why we feel that in this budget also, the government is going to increase their allocation to capital expenditure. This means that infrastructure stocks, capital goods stocks, engineering stocks should do well. We also feel that to support the economic growth, there would be increase in the allocation for production-linked incentive schemes. That means that some segments of the manufacturing sector should do well. So these are some of the spaces that we believe will do well in the run up to the budget.
Technically, charts suggest a bullish outlook for sectors like capital goods, metals, real estate, and auto indices in the run up to budget 2023 and also later. Analysts forecast up to 10% upside for these sectors in the near term.
Some of the sectors which are looking very attractive ahead of budget and can display some bullishness, that is banking and financial, metal and IT, power and oil and gas, and real estate. These all sectors are looking very promising, and we believe that these sectors can display some bullishness post budget event. Looking at the real estate space, real estate sector managed to give breakout of its long consolidation in current year, and looking at overall setup for real estate sector, we believe that some more upside we can see in the near term basis. So we are projecting around 4 to 5% upside momentum in the continuation of this pullback trade which we are witnessing since last couple of a month. From those space, we like Prestige, Shobha, and DLF. Another space is looking attractive on the automobile space. Almost automobile index is trading near to its all-time high trajectory, though there was some corrective action in recent past. But overall, the most of the stocks are showing good buying interest, and we believe that automobile index can do well, and possibly 5 to 8% upside we can expect in coming months. Another sector, that is capital goods. Again, capital goods stocks are showing good buying interest since last couple of months. Stock like L&T, Siemens, ABB, most of the stocks, Cummins India, are showing good strength, and overall capital good index is trading almost near to its all-time high trajectory. So looking at overall scenario for capital goods, we believe that this index can continue its uptrend, as the technical setup is looking very bullish on the short to medium term perspective also. So capital goods can be a sector where we can expect 4 to 5% upside in the continuation of uptrend. Metal is also looking positive after a corrective action. Since last 2 3 months, we are seeing significant buying action from the lower level in the metal space, and most of the metal stocks have recovered and almost now trading above their 200-day DMA, so which is also adding up the bullishness in the near term basis. And looking at the metal space, so we believe that 8 to 10% upside we can expect in the metal space going forward. So metal space is also looking promising ahead of budget.
So far this financial year, sectoral indices like the S&P BSE Capital Goods, BSE Auto and BSE Bank have surged up to 24%. However, the BSE Realty and BSE Metal indices have dropped up to 10% during the same period. By comparison, the BSE Sensex has surged 2.7% so far in FY23. As regards today, Q3 earnings season, global cues, crude oil prices and fund flow action will sway the market mood. Companies like Bajaj Finance, Vedanta, Glenmark Life and Aarti Drugs will report their Q3 numbers on Friday.
Meanwhile, India is also working to develop its own operating system on the lines of China to boost its economy. Two union ministers recently took part in the testing of BharOS, which is now being dubbed as India's answer to Google's Android and Apple's iOS. Khalid Ansar tells more about this indigenous OS.
While testing India's own operating system before the media, Union Electronics and IT Minister Ashwini Vaishnaw on Tuesday said that it was a work in progress and a step in the right direction. With Union Education Minister Dharmendra Pradhan by his side, Vaishnaw also warned of challenges that this indigenous OS may face.
People don't want any system like this to succeed. So we have to be very careful, very cautious, very persistent. Continuously we'll have to keep working on making it successful.
BharOS is based on Android Open Source Project AOSP, making it a forked version of Android sans Google and other first-party and third-party apps. Developed by Jan DK, Operations Private Limited, which is a non-profit organization incubated at IIT Madras, it doesn't have any default app. Developers claim that it will offer a more secure and private platform compared to existing operating systems. Absence of any default app means that the control rests with the users and they can install apps of their choice. According to IIT Madras, this approach would allow users to have more control over the permissions that apps have on their device, as they can choose to allow apps that they trust to access certain features or data on their device. This is also in tune with the steps that the Indian government has been taking for a while. Google is finally working with mobile device makers to unbundle the distribution of Play Store, which is linked to the current policy, where the latter have no option but to pre-install a suite of around 9 leading apps on their devices. BharOS gives access to trusted apps from organization-specific private app store services or PaaS. In the PaaS, BharOS provides access to a curated list of apps that have met certain security and privacy standards of organizations. Only the apps checked for any potential security vulnerabilities or privacy concerns are listed in the PaaS for users to install on their mobile devices. BharOS gets native over-the-air updates to ensure that the supported devices get the latest version of the operating system. In the words of Professor V. Kamakoti, Director IIT Madras, BharOS service is a mobile operating system built on a foundation of trust with a focus on providing users more freedom, control, and flexibility to choose and use only the apps that fit their needs. This innovative system promises to revolutionize the way users think about security and privacy on their mobile devices. The operating system is currently being provided to organizations that have stringent privacy and security requirements. IIT Madras is set to have plans to work closely with private industry, government agencies, strategic agencies, and telecom service providers to increase the usage and adoption of BharOS in the country. For consumers, BharOS is expected to bring a flexible experience that neither Google Android and Apple iOS offer in their current form. It is because Google Android is heavily dependent on Google services and Apple iOS is a walled garden. Both Google and Apple justify their approach by citing concerns from users' privacy and security perspective. It is yet to be seen how BharOS does on this front.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Experts have meanwhile pointed out that BharOS is a fork version of Android and not an original operating system. It means that the developer has copied the source code of the Android OS, which has been an open source project. And such programs will have more bugs and will be susceptible to hacking too. That is all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.